The following pre-recorded program is sponsored by Adams Financial Concepts. Welcome to About Money, a different approach to investing you won't hear anywhere else. Your hosts, the AFC team, Mike and Al, are registered investment advisors who have a proven track record of managing long-term investments, surpassing the markets. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's your AFC team, Mike and Al.
And it is Saturday, and we're going to be talking about money. We're going to be talking about advisors. We're going to be talking about our industry. Barron's did a report on the robo-advisors. You know, those are the electronic advisors that all you do is you get plugged into a program and you get the whole thing. They, in 2023, reached $1 trillion of money that they were managing. Compare that to 2018, they were $300 billion. So they tripled in that period of time from 2018 to 2023. And in 2018, the total stock market was about $30 trillion. They had about 1% of that market. Today, the market is about $50 trillion, and they have $1 trillion. So they've gone from 1% to 2%. And Fortune Business Insights is forecasting a 30% compounded annual growth rate, which, if it is realized, would put that $1 trillion growing to $10 trillion by 2032, just in 8 years. At the same time, the total market, they expect to grow to $80 trillion, which means robo-advisors will move from 2% of the market to 12.5%. They will truly be a force in the market. And it reminded me, 25 years ago, I had a travel agent. And I asked the travel agent, didn't you think that the internet was going to have an impact on travel agencies? No, he said, travel is really complicated. It's complicated to select the right airlines and the right hotels and the cars and plan out the trip. Travel agents have job security. You'll always see a lot of travel agents. Can you remember when there was a travel agent on almost every street corner, when there were 6 in every mall?
I do.
Today, you don't see any of those travel agencies. We do use a travel agency for international travel, but there's not many. It's few and far between. You know, we want to talk about the robo-advisors as we talk about our industry and what's happening in the industry, because you, the listeners, are going to be impacted, whether it's robo-advisors, whether it's companies that are rolled into other companies, whatever happens, we're in an evolutionary industry. And I go back 38 years. I go back a long time. And I've seen it before. You know, when you think about it, let me ask the question, Al, what's the biggest brokerage firm?
Schwab.
What's the second biggest?
Probably Fidelity.
Vanguard. What's the third?
Probably Fidelity, right?
Fidelity.
Yeah.
Right on. I mean, Schwab has $9.6 trillion, 20% of the market. Vanguard, $9.3 trillion, which is another 20%. Fidelity, $5.5 trillion. And before you get down to the big brokerage firms that used to dominate the market, JP Morgan Chase has $3.5 trillion. And the biggest firm of the time when I got into the business, the very largest, by and far larger than anyone else, was Merrill Lynch. They have 1.8 trillion. They have just twice what the robo-advisors have at this point, not even twice what they have.
But aren't they starting their own? A lot of them bought the robo-advisors, starting their own. I don't think remember the robo-advisors were, when they came out, were all independent tech firms, right?
Yep.
And then they got bought up. I think there's only one left. Who was it?
Betterment.
Betterment is the only one that's still not owned by one of the large banks or institutions.
No, there's 4 or 5 that are actually independent.
Oh, there is?
Yeah.
Okay.
But the banks and institutions own most of the robo-advisors.
Yeah.
Which means there's a big incentive for them to use it.
Mm-hmm.
So, you know, when I licensed back in 1986, not only was Merrill the largest, but they really dominated the market. I started with Payne Weber, which is now UBS. And what people told us is, don't worry about Schwab. Schwab is for do-it-yourselfers. They reminded us that back in May 1st of 1975, before May 1st, 1975, commissions were fixed. If you bought 100 shares at $30 a share, it didn't matter whether it was Merrill Lynch or whether it was Payne Weber or whether it was Dean Witter or Kidder, you always had to pay exactly the same commission for the same number of shares bought at the same price. It was a fixed price. But on May 1st, 1975, the U.S. government decided to let fees be negotiated. And the brokerage houses had close to 100% of the market.
What was the old commercial, Mike? Was it E.F. Hutton when E.F. Hutton talks, people listen.
Is E.F. Hutton talking?
Do you remember that commercial?
I do. I remember it well.
Yeah.
I was in that. I applied to Kidder and E.F. Hutton in those days. Charles Schwab at that time had a different idea. 1975, zero income, zero brokerage, but he decided to do a brokerage discount house. And we were told in 1986, now this is 10 years after he started, that it was all do-it-yourselfers. They really needed a full-service broker to take care of their accounts. They needed somebody to talk to, somebody to plan out. Most people didn't know how to take care of their money, and so you had a really small segment of the market, and usually there were people that couldn't really afford a full-service broker. They were trying to save $2 here and $3 there to make small trades of 10 shares or 5 shares or whatever. They weren't going to really have an impact. Just like the travel agent that said, it's really complicated. The business is really complicated. So how did it work out? By 1999, 33% of the clients, from the tiniest to the largest, 33% had at least one discount broker along with their regular brokerage account. It was a significant change. 95% of the revenues were in big houses by 1999. The average income in 1986, the average family income in 1986 was $43,000 for a family, both a husband and wife working. And yet the brokerage firms, for a broker that was only generating $43,000 in income, they were moving them out of their office. They were getting rid of them. They were dumping those brokers and forcing those brokers to become independent.
Well, I remember before 2008, Mike, most brokerage houses, like you're talking about, didn't care about accounts that were less than $100,000. They could care less about. They would have them, and they could care less about them. Right? The big banks did 100,000, 150. They didn't really care. They only wanted big accounts. But after 2011, and I think to your point, with Schwab, when Schwab really increased their market, it kept increasing their market, they started chasing those small accounts down, realizing, oh wait, those small accounts can actually, they start to add up after.
The mass market for investors is the 100,000 to 1 million. A lot of financial advisors set their minimum value at $1 million. Mm-hmm. Or 500,000. Take Fisher, they do 500,000. You gotta have 500,000. If you don't have 500,000, they don't want to talk to you. In 1988, Merrill decided to any account of less than 30,000 would go to a call center. So instead of having an advisor, you had an 800 number to call. And eventually, when you got through to the person at the other end, it wasn't much different than the discounted brokers at that time, who also had a call center. Mm-hmm. And the discount brokers were cheaper than Merrill Lynch.
Oh, I remember liquidating a Merrill account back then, and they wanted, just to liquidate the account to sell the stock, they wanted $300 a transaction. And the woman had 40 stock, and they were, and they wanted, I think it was $300 a transaction.
Yeah.
It's crazy.
Yep. But that was a time in which Merrill ruled, and the other brokerage houses, no matter who it was, Payne Weber, Kidder, Dean Witter, all those firms went along essentially with what Merrill was doing. Mm-hmm. Merrill was setting the pace. Merrill doesn't set the pace anymore. Schwab sets the pace. Fidelity sets the pace.
The whole
Vanguard.
The new thing, the knock on all the brokers, even the discount brokers. What happened when Schwab and TD merged? They were in their price wars, right?
Yep.
To the bottom, right? No, we'll charge zero trade, zero fee, zero commission. As soon as they merged, what do? They raised their fees. And then the big knock on them today now is their sweep accounts, which, if you don't know what a sweep account is, it's basically the money if your money's sitting in the account at Schwab and you're waiting to see what investments you want to put in, you're not sure, that money gets paid an interest rate.
Yep.
Now, most of these big brokers, even those discount ones, are giving you about, I think it was less than 0.5%.
Yep.
For your money to sit there, when that money could be in a money market or a CD earning probably today 4.5%, maybe close to 5%.
But they're also loaning that money on margin.
Yeah, right.
At 5 and 6 and 7%.
And 12% 12% margin on those, right? And they're not giving their clients anything. So if you're a client in one of those firms, you better look at your sweep account and see what you're being paid. If you're not being paid anything, put it in something else. It's at least money market, so you can at least get a better return on your idle cash.
And for all the comments about fiduciary, the brokerage firms are in it for themselves.
Yeah.
They if if the client's objectives line up with the firm's objectives, they do the client's objectives. If the client's objectives are not the same as the firm executes its objectives first. I mean, that's why Merrill Lynch today is $1.8 trillion.
What about the other advisor we talked to who said he wouldn't work with them anymore? He had to move his stuff because once an account got big enough, their advisors would call and compete with the advisor who had his business, maybe 50 or 100 clients.
Yep.
And once the client got, come back in a few minutes. We'll pick this up again.
Yes. Don't go away. We'll be right back.
About Money with your AFC team, Mike and Al, on AM 1300, The Answer. For more information, click on adamsfinancialconcepts.com.
Yeah. Al, you were talking about...
So we're talking about an advisor who they can choose where they place their assets to build their book of business.
Mm-hmm.
And the advisor, Ted, was with Schwab. And once an account got big enough, Schwab would then have their own advisors call that other advisor's clients, trying to poach the clients to come over to Schwab and pay less fees.
Yep.
How would you like that for your business?
So, I mean, once Schwab and Vanguard and Fidelity are now the huge players in the market, they can get away with doing those kind of things. So if Adams Financial Concepts happened to be at Schwab, there's no question they would come after and
poach our clients.
Yeah. And we're seeing that. We have a 401k that it normally would take 3 months to move. We're 6 months, and finally, this week, we got the cash moved out of the Schwab account. But the client spent 3 hours one time, then was told everything is fine, it'll move. He spent another 2 hours, and it didn't get moved. And I had to threaten to hire an attorney. And they said, oh, okay, well, maybe somebody screwed up. Yeah.
Mm-hmm.
It was not a screw-up. It was an intentional. They want to keep the assets.
Of course.
And they have no loyalty to any of their any of the RIA advisors, because the RIAs are very, very small compared to Schwab. They now control the market, 20% of the market. And Vanguard controls another 20%. Add Fidelity, and between the three, they're approaching half of the market. Half of the assets are at those three firms. So they can set the pace. They can do what they want to do.
Fidelity's a black hole because they're not publicly traded, so you have no idea at all.
Yeah.
Privately held company.
I was at Fidelity at one time. I housed my assets at Fidelity. When I came out of, I was with Wachovia Securities, went independent in 2005, and in 2005, the broker-dealer that I was working with was Mid-Atlantic Capital out of Pittsburgh, and they were housing their assets at Fidelity. And Fidelity had their own system of working, but you also could see there was a potential risk. And by 2015, they were trading client accounts. Trades were being done in dark pools.
Mm-hmm.
Could never be assured that clients were getting the best execution. Until I read Flash Boys, I didn't really realize what was going on. And realizing, and it wasn't a big amount. It was maybe 10 or 15 cents.
It's trivial
for a trade.
It's trivial to us and our clients, Mike. But the point is, the principle, right, is that they do that enough on trillions of shares. It's a heck of a lot of money.
It's billions of dollars they make.
Yes.
On that 5 cents or 10 cents or 15 cents.
Yeah.
And when I ask to be able to select the exchange, oh no, you can't do that. That's proprietary. With Interactive Brokers, I can choose our own exchange where I want to do the trades. I can look at every exchange and make sure that I'm getting the best execution,
mm-hmm.
and then execute the trade. But that's unusual, and it's going to continue to be unusual. But there's a new player in the
robo-advisor.
The robo-advisor. And I'm going to guess it's going to squeeze both the big brokerage firms, the RIAs, and the Fidelities and the Vanguard. Although the number one robo-advisor is at Vanguard. They haven't missed.
Yeah.
Fidelity has a robo-advisor. Schwab has a robo-advisor.
Right.
They understand where things are going. And so the biggest squeeze will probably be on the big firms, the Merrill Lynch's, the UBS's.
But I think they have robo-advisors too. I think they've all bought in a robo-advisor.
But they're not as flexible, or they're going to squeeze their own brokers.
But you and I have talked about the automation of the market, where 75% in the trade are being right.
Yep.
I mean, nobody's making the trade. You spoke about your daughter in her investment. She runs the investment small biotech. She's head of investment relations.
Investor relations, yeah.
Couldn't get the word out. And she's writing to the algorithm. They can look at the stock.
Yeah, they no longer write to human beings. They write to the computers.
To the computers. Look at
and
the
up
stock.
to 90% of the trades are done by computers.
Right. And so as this automation and AI keeps playing out and robo-advisors keep growing, don't you think that represents more of a risk as far as if the markets read something, if they read something negative that, everything's just going to tank all at the same time? Is that circuit breakers stop?
So the advantage of the computer algorithms and the rapid trades they're doing is they're trading for pennies on the share. So we have a stock in our portfolios. The trading prior to 2019 was 1 million shares a day. Now it's 30 million shares a day. It's one of the most shorted stocks, and it's traded up and down. As the stock moves a little bit, they buy and sell. And what the computers do is if the price is $40, the last trade was $40, they might offer to buy at 40.01. They'll put in another order for 40.02, another 40.03, another 40.04, another 40.05. So almost 90% or 99% of their orders never fill. But what they have is this stack of orders in. And if you suddenly get somebody that wants to buy a whole bunch, the first bunch will go at 40.01, the next bunch at 40.02, the next at 40.03, and they just kind of work it up. And so the one that they bought at 40.01, they'll turn around and sell at 40.06. As soon as the buying is over, then they turn around and will move that block of stock at 40.06 or 40.07 or 40.08. And so you get a lot of trading, but the assets they control is not that great. Over 50% of the assets are held in mutual funds and ETFs. Maybe it's closer to 60%. But the trades that they're doing are very frequent and very often, and they trade 90% of the volume, but they're trading the same thing over and over again. So they're very short-term traders. They hold a stock for maybe a second or two.
They call those snipers.
The problem with the computer programs is no one has come up with an algorithm where they can show that they're beating the S&P 500 over the long term. And until they do that, well, if they did that, they would publish the numbers. For the most case, they don't publish what returns they're getting. Their investors are seeing the returns. But you see a lot of cash flowing in and out of the algorithms. They will have good times and they have bad times. And the cash will flow out on a monthly basis. So, that's, if they're doing well, cash flows in at the end of the month. And if they have a bad month, cash flows out. So, and for an algorithm, it doesn't matter whether you're doing 100 million or 300 million. It changes the number of orders you put in and take out, but it doesn't trade much. But the big amounts are held at Schwab and Fidelity, Vanguard. And my guess is that the robo-advisors are going to squeeze them all. Now $1 trillion, $10 trillion by the end of 2032, 12% of the market. And their fees are somewhere between 5 and 10% of what, 10 to 15 or 20% of what a financial advisor. And we've talked about it. And you've mentioned that there are a lot of small investors or relatively mass market investors, 100,000 to $1 million, who don't know what the markets are doing and need a guidance.
They need somebody, yeah. For the people who want to do it themselves, good luck to you. But there's a lot of people who don't. And feeling like you need to do it yourself can be a detriment to your money.
So the knock on robo-advisors has been, it's going to be the do-it-yourselfers. It's going to be the low end of the market. But that doesn't really
make any sense because you're not doing anything yourself. The do-it-yourselfers want to sit there and pick they have a Schwab account because it's cheap and they want to pick the investments. The robo-advisors are people who don't want to do anything. It's all automated for you.
The robo-advisors will do a financial plan.
Yeah.
They'll do an investment allocation,
a risk analysis, and then they'll say, okay, this is how you're going to invest. It's almost the only way I can think of it. I haven't used it, but like buying the target date funds, right?
Yeah.
Is that okay? If someone does a robo-advisor when they're 30 with $100,000, and okay, as they get 40 and 50, maybe it stays aggressive, and all of a sudden it starts to get really conservative. That's what I think. Wouldn't that make sense for the algorithm to say you're 30, you should be aggressive. Now you're 40, be less aggressive. 50, less. 60, less aggressive.
Yeah. It will do some of that.
And their compliance, they have to tailor it that way. They can't just have someone, we're going to stick with the aggressive investments for the next 35 years.
One of the interesting things is the robo-advisors during the downturn, in 2020 when the market went down and individuals were hunkering down and not doing anything, the robo-advisors were buying stocks. They were buying them at the low for their client or buying mutual funds, buying whatever. They had and there's a reason that they do that. We're coming to another break. Don't go away. We'll talk about why people are choosing robo-advisors. That's coming up. It's a significant part of what's happening in our market, and it's probably going to continue to become a bigger part. Don't go away. We'll come back and talk about this. We've got other things to talk about as well. Lots to cover.
About Money continues. Remember the website, adamsfinancialconcepts.com. Here's your AFC team, Mike and Al.
So, remember, when I got in the business in 1986, we were told, don't worry about the discount brokers. It's going to be the do-it-yourselfer. It's not going to be a significant part. Today, they dominate the market. But you're hearing the same kind of thing about robo-advisors. So there have been a couple studies that have been done. My private banking surveyed 70% of their high net worth people with over $1 million in liquid assets. And BlackRock did a study of their bread and butter clients, those with $500,000 and above. And 49%, almost half of the people in those studies said they were considering a robo-advisor. And the BlackRock study went on to say why. And the response, 42% of the people said they were convenient. 32% said they make it sound simpler. 31% said there's no product push. It's objective. 27% said lower cost. It wasn't the top reason. Listen to people today, they'll say it's only the people that are looking at the cost. No, it's convenient, simpler, no product push. 26% said there's more choices than they have now. 24%, 1/4 of the people said, we believe you get objective advice from a robo-advisor, not from a financial advisor. 18% said they expected they would get better advice from a robo-advisor than they would from a personal advisor. That's the bread and butter clients of brokerages and RIAs too. So you talk, and over the last 6 or 8 years, I've asked some of the financial advisors, don't you think that the robo-advisors is a threat? And essentially their answer is always the same. They say, look at us. We listen to our clients. We see their concerns, their goals, and their risk tolerances, and we develop it. I lifted this from Edelman Financial, one of the top financial advisor firms, rated by multiple sources. Edelman is number 3 in recognition. Jim Cramer is first, Susie Orman is second, and Edelman is third by recognizing financial advice. Not that I believe that Cramer or Susie Orman gives great financial advice, nor Edelman. But this is what their website says. At Edelman Financial Engines, our advice is personal. We start by assessing your financial goals. Then, using our proprietary analysis and advanced investment engines, your financial advisor will help you select a personal portfolio that's uniquely aligned with your goals and risk tolerances. This isn't a one-time event, though. It's the beginning of an ongoing relationship that will continue as you move through each stage of life and your situation and circumstances change. Doesn't that sound wonderful?
It sounds wonderful, but this is, you know who Michael Kitces is.
Oh, yeah.
Michael Kitces talks about this all the time. He says, what's your value proposition, right? And the Edelman and all the other value propositions, he said, no, that's the job. That's the job of a financial advisor. That's your fiduciary responsibility. It's in the wording that when you sign up to do this job, that's what you're supposed to do.
Yeah.
So you can't use that and say that's your value proposition. It doesn't make any sense.
That's a requirement.
Yeah, it's a
of
requirement.
Know your customer.
Exactly. It's called know your client rule. Exactly.
I mean,
duh.
It's phrased. The better way to say it is we're all required to know our customers. Yeah. We have to know what the advice is personal. It suits the client themselves. No client is exactly the same. But I'll tell you another thing. Edelman did try to recruit me. And Edelman has their system set up so standard. They want you to have an office with your desk facing the window. And behind your desk is a coffee table. And on the other side of the coffee table is a Davenport, a couch. So that when you have a meeting with the clients, you swivel your chair around. They sit on the couch. You have the coffee table in between the two of you. They get to look out at the view out the window. And there's no books, there's no articles, except those that are written by Edelman and approved by Edelman. You don't don't want a Wall Street Journal because there could be negative news in the Wall Street Journal. You don't want anything negative, but only Edelman content. And he related the story that there was an advisor who got sick, and they just had another advisor plug in the information into the computer and gave that to the clients that came in. Absolutely cookie cutter approach. Everybody gets the same thing. Your number, the only personal part of you is what numbers you put into the computer. Everything else is the same. The projections are the same. The investments are the same. Look at the whole thing. It's just cookie cutter. But they also say they have no compliance problems because everything is standard. They have no issues with what goes on. And yeah, the returns are not that great. But then it means their whole focus is don't lose money for anybody. And they don't really care what the returns are, if they're 1% or 2%, as long as they're positive. They don't care if they're 1%. They're making money for the clients. Well, the market might be up 15 or 20%, but if your clients are making 1%,
it's like the one
they're not losing money.
That I got recruited.
And that was the most recent one.
Yeah, just a week ago. What type of input can I have on the investments? What do I do with the clients I already have? And they said, well, we'll buy the clients. And I said, well, what do we put in the clients and what type of investments? We're heavy into the annuity business. And I said, okay, so I saw the TV stuff, and they talks about advanced. We can help you. They put some CPA on, and we have advanced tax strategies to help you. The advanced tax strategy is putting you in an annuity that has, the deferred gains. That's your tax strategy.
Yep. It's called tax efficiency. It's not really tax efficiency, but it's the same kind of spin that Edelman puts on it. And every financial advisor at Edelman is required to do this. But then so is every robo-advisor. They will give you a cookie cutter approach as well. And it will also be geared to the individual client, put the numbers in, and it will be a personalized.
Well, it's and I'm just going to go out on a limb here but if you do a robo-advisor with any of the big firm, they're going to use all of their funds.
Yep.
Are they going to say, we'll get a BlackRock fund in there? If you go to Vanguard, is Fidelity going to say, we'll pull in, Legg Mason Fund or Loomis Sales or any of these other funds?
Yeah. So is it worth paying 5 times to have a financial advisor? But the question you raise is a different one, is one that I want to shift to as well. So wouldn't it be nice if you had a week-long escape to, I quote, one of the most privileged locations in the white sands of Punta Cancun in Mexico? Or if you had a luxury Danube river cruise? That's what financial advisors get just for selling $200,000 of annuities. All you have to do is sell one annuity to 2 people for $100,000 or one annuity for $200,000 to one person, and you get one of the most a week-long escape to one of the most privileged locations in the white sands of Cancun in Mexico. Or you might choose a luxury Danube river cruise. Or some will get an extra $4,500 bonus in addition to their commission just for signing 3 getting 3 insurance contracts signed by 1, 2, or 3 different clients. It's really nice for the advisor, right? But you know who's paying for that? You know who's paying for those trips?
The clients pay for it.
The clients are. It doesn't show in their commission disclosures. It doesn't show up anywhere. It's all hidden. But it comes out of your earnings. The money that you're plugging in is not just working to your benefit. It's paying for your advisor to take one of those beautiful week-long cruises or week-long vacation in Cancun or Madrid or Mallorca or somewhere else in the world. It's coming out of what you get. It never shows, and it's never disclosed. Under regulations, it's supposed to be disclosed. Dodd-Frank and the things that came out of Dodd-Frank and out of the Department of Labor said insurance companies need to disclose this, but they never disclose it because they've figured out how to hide it legally. What they do is they set up separate sales and marketing organizations and field marketing organizations. And it's those companies that buy the cruises and send the vacations and send the extra bonuses. So the insurance company can sit back and say, this is nationwide. We're on your side. They don't say, we're nationwide. We're screwing you over so that we can send our insurance salesman to a Danube river cruise or to Cancun, or give them an extra $4,500 because they actually sold 3 policies instead of 1. all of that now is coming up in investigations going on with the Department of Labor. The Department of Labor has come out with a new fiduciary rule that says what you should do is in the best interest of your client. And the insurance companies are fighting it. They want to take it to court. They want to have it overthrown. The insurance companies are saying it's putting our advisors at a disadvantage. It really isn't fair.
Well, they want to stick with their suitability ratio.
Yeah.
It basically says if you can justify it's suitable, you can do it.
All you have to do is to say it's a suitable investment. Right. They want to put these annuities into 401ks.
Oh, they've already done that. That's not a done deal.
Oh, yeah. But they don't want to disclose any of this information.
Yeah.
They want people to buy the annuity and say when you come out of your 401k, then you won't be taxed on it. Mm-hmm. Anyway, don't go away. We'll come back to this after this commercial break. A few more things to go through. A few more things, all in our industry. But just understand, you're the client.
About Money with the AFC team, Mike and Al on AM 1300, The Answer. For more information, click on adamsfinancialconcepts.com.
So we've been talking about the insurance companies and their pushback on the Department of Labor rule. Companies like Nationwide that want you to believe they're on your side when in fact they're rewarding financial advisors to sell you annuities that are going to have terrible performance at best.
And they lobbied for years after 2008 to get annuity into 401ks and finally got them in there. And then the markets decided, okay, we're going to put annuities in 401ks and at the same time put cryptocurrency, EFTs in it.
Yeah.
Okay.
So, but it's not just annuities. TIAA-CREF has just had a whistleblower that came out because TIAA-CREF puts a lot of pensions for school teachers and nonprofit. And they've been pushing the school teachers and the nonprofit savers to use in-house tools to estimate their retirement. This is what you're going to need for retirement. And when you use those tools direct you to in-house products, to mutual funds, and to ETFs that TIAA-CREF has sponsored. Mm-hmm. And TIAA-CREF is making billions of dollars. And not only that, the TIAA-CREF financial advisors get bonuses if they can persuade 170 customers to invest in those investments.
Oh, I know a guy who works for him. I know him. He's telling me they put these impossible goals of taking in this money and moving this money, and the bonuses for doing that.
Yeah.
And they use a lot of annuities too.
And none of it is disclosed. And who's paying for that? The client.
And they work a lot with professors, do a lot with the university.
Yep. And so it's no wonder that the robo-advisors are growing as they are, because it truly is. They're getting better advice than they're getting from a lot of financial advisors. Not all. There's a lot, and I happen to think that we're some of those. We're completely transparent in what our fees are and what our costs are. Our clients know exactly what they're paying, and if they don't know, they can look it up. It shows right on their statement. It's all there. Every single bit of it. There's nothing that's not disclosed. They get to see what's bought and sold. They get to see the price. They get to see everything that goes on. That's what we do. But let me come back to our industry. I want to come back. We started with the industry. Something's going on within our industry which has concerns to a lot of the industry insiders, and that's that organic growth is slowing down. Organic growth is everything except for market returns. So if your account goes up from 100,000 to 200,000, that's market growth. Organic growth is the new clients that firms are bringing in, less the clients that are leaving. It's the clients adding money, less the amount that's going out. And what's happening is that organic growth, which compromised 8 to 10%, has dropped to below 4%. It's dropped, and it's continuing to drop. Baby boomers are retiring, and instead of putting money into their account, they're taking money out of their account. And so organic growth is slowing down. And there's concern in the brokerage world, what's going to happen over that. Add to that a second problem is that almost 40%, 37.5% of financial advisors plan to retire over the next 10 years. We're old. We're really old. And there was a time in the 70s and the 80s and into the 90s when being a stockbroker, that was before we were called financial advisors, when that was a lucrative business. You can do the research and see today the average financial advisor in the state of Washington is making $125,000 or plus or minus. That's the average. I can remember doing more than twice that a few years after starting as a financial advisor. Maybe 5 years. But anyway, and I wasn't alone in doing that. Now they're getting less. Fees have dropped down, and that whole group of financial advisors, stockbrokers who started in the 60s, 70s, 80s, and 90s, they're getting close to retirement age. Some of us are well over retirement age. We just like what we do. And what happens to the clients? The regulators are pushing hard for firms to have a succession plan. Some of those firms are selling themselves to other firms and selling their client books to other firms to retire. Some are sold to younger partners, but a lot are being sold to outside firms. And the biggest ones are being rolled up into other firms. In 2011, there were only 10 registered investment advisor firms that managed $10 billion. Last year, it had soared to 258. That's not been a growth in client assets. Client assets are growing at 6 or 7 or 8% a year. That's a growth of buying other companies. And the forecast is in the not too distant future, there'll be a registered investment advisor firm that has $1 trillion under assets. It'll be as big as some of the big brokerage firms. And as they roll these up, who's funding a lot of it? Private equity is funding 75% of the mergers. And what do they mean? They often promise firms will just continue to do what they're doing until the advisor retires, but the back office is going to move to roll up. And what that means is the compliance rolls to the new firm. That means the investment options rolls to the new firm. What was it? You were talking about the people that called you last week? Mm-hmm. And what did they offer in terms of investment options?
Annuities. They're heavy on the annuities.
And what about the back office? And compliance?
Oh, yeah. I had no control over anything.
It reminds me.
They had all scripted out that this is what you do. We set the appointments for you. You go and meet the appointments here or meet the appointments at this office, and that's it.
Yep, all scripted out.
Yeah.
It reminds me of Henry Ford in the 1930s, who said, "We will sell you a car any color you like as long as it's black." You can have any color you choose as long as it's black. That's what these financial firms are doing. You have completely freedom to do whatever you want as long as it's what we tell you you have to do. Mm-hmm.
Well, there was a big lawsuit, Mike, with LPL, who's got 43,000 advisors.
Yep.
Because what they did is they had these RIAs on their platform, and the RIAs went to do what's in their client's best interest, went to a different platform. Well, LPL to cut out of their commissions and their fees off of that and said, hey, you can't do that. You have to get our permission to do that. And the RIAs looked at them and said, the heck we do. We're responsible to our clients, not to you.
Yep.
And they're leaving LPL. They're like, no, we're leaving. Why? We don't want someone telling us what to do. Well, you want us? Well, they had they had a $8 or $9 billion under management. It said to LPL, go stick it. We're leaving.
Anyway, if you find your advisor is retiring and selling and you have a new advisor, check out. It's not what they tell you, it's what they do. Be sure that you're getting the real advice you should be getting. Not saying some won't be good, some will add value, but my guess is that it's the old saying, it's not diversification, it's diversification. It's going to be worse rather than better in a large majority of the cases. And most people who are listening to this program are with an advisor who probably will retire in the next few years. So be aware and know that if it's Saturday, we're going to be talking about Monday. So join us next Saturday. We'll be back with a lot more to say. So much going on in our industry. Know that our clients get our best attention.
You've been listening to About Money with registered investment advisors Mike Adams and Al Souza. If you'd like more information about what you've heard today or about AFC's investment philosophy and strategy, or if you'd like the AFC team to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared in the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Saturday at noon for more About Money with Mike Adams here on AM 1300, The Answer. The preceding program was sponsored by Adams Financial Concepts.